Hello, everyone. Thank you for joining us today. So, while TIF is a subject that can get complicated and detailed, this presentation attempts to provide a thorough but accessible overview to introduce the key concepts, context, and attributes of tax increment financing in Minnesota. It is also meant to be a valuable refresher for those that have kind of intermittent experience with it and might appreciate the recontextualization. And an additional webinar on TIF administration for authority staff will be held this Thursday, July 17th. That'll also be released as a video afterwards in case you can't join live. And then there's also a webinar coming up for county staff that'll be held on July 31st. And again, we'll post that one too if you aren't able to join us live. Okay, well, let's begin with the basic question, what is TIF? TIF is different things to different people. Actually, it's a public financing tool for businesses and economic development professionals that look to initiate projects. It's a revenue type or fund to finance directors and accountants who handle financing activities. It's a feature of the property tax system for county auditors and affected taxing entities. And for all involved, including us as oversight administrators, it's a statutory program. And perhaps the key takeaway is to not just be limited by your narrow perspective on duties and to understand that there's laws and limitations and compliance components that need to be understood. And that's especially true for TIF authorities making use of TIF. And someone for each TIF authority should make sure they have their eyes on the bigger picture. And hopefully this training can help raise awareness to what that bigger picture is. So getting more specific, let's start with a brief illustration here of how TIF affects property values and taxes. So normally when you have a new value or new development, that new value that's created by private development, it immediately becomes part of the tax base and produces a share of tax levies. But when tax increment financing is used, the new value is actually captured for the life of the TIF district and does not become part of the tax base until after the TIF district ends. So while the TIF is active, only the original value is still part of the tax base. And the taxes on the new value, the tax increments, they're used to pay debt instruments that finance costs that enable the development to occur. So, and you might think, well, this capturing a value, that seems like a negative thing that could hurt the tax base. And it is if the development doesn't need TIF. But if the new value would not happen, but for the use of TIF, and TIF is being used to truly enable that new value, then this capture of value in taxes is considered a neutral necessity that produces the greater tax base when the TIF district ends. And if it wouldn't exist without TIF, its capture doesn't take anything away. So local governments using TIF must make actually a but-for finding regarding the use of TIF, that the development wouldn't happen but for the use of TIF. So to provide a definition, therefore, we can say that tax increment financing, or TIF, is a financing tool where new value from a development is captured from the tax base so that the property taxes on the captured value, i.e. the tax increments, can instead pay qualifying costs that enable the development to occur. And as we go along here, I'm going to come back to this definition and talk in more detail about each of its parts. First, though, let's look at who uses TIF. The municipal bodies that use TIF, we refer to them as TIF authorities. And the term TIF authority derives from the fact that municipal bodies get their authority to use TIF and to undertake various development projects from various development acts. And the most common TIF authorities are cities and city entities like port authorities, economic development authorities, and housing and redevelopment authorities. County and multi-county HRAs, rural development finance authorities, and one large metro township can also be TIF authorities. And the development acts that are listed here for each, they govern how projects can be undertaken. So the TIF Act does not authorize projects or the use of TIF. Instead, it regulates how TIF works and how it can and cannot be used, but with some limitations. So it's important for TIF authorities to be well versed in both the laws authorizing and governing the use of TIF and the TIF Act. And unless there's some specific authority for a type of local government entity to use TIF to undertake a development that generates TIF, the TIF cannot be used for just kind of anything. In 2023, 378 authorities filed reports for 1,678 districts. There's another 4 TIF authorities that failed to report for 6 districts, and so they're subject to their increment being withheld until they get the reporting in. TIF authorities include nearly all cities over 5,000 and a large number of small cities. TIF was used also by 9 county entities, and this map is just showing the individual county entities, but there's also a couple of multi-county entities that also made use of TIF. And 61% of TIF districts created by these authorities are located outside the metro area, but 78% of the tax increment dollars are generated in the metro, where the values are higher and the projects tend to be a little larger. So logistically, the development acts govern the project areas in which broader development activities occur beyond just the TIF supported developments. Sometimes, and actually quite often, those boundaries are coterminous with the city boundaries. So TIF, though, is used more narrowly by creating TIF districts that consist of the parcels on which the financed development will occur. There can be many TIF districts within a single project area. And districts are where the tax increment is being generated, and it's where most of the increment must be spent. But you understand that you can use some increment outside the TIF district and within the larger project area. And we'll talk about that more momentarily. You might notice that TIF authority names are often something like TIF 1-3 or TIF 2-1. Generally, that first number refers to the project area, and the second refers to the TIF district in the project area. So for example, TIF 1-3 might be the 3rd TIF district in project area number 1, although not all TIF districts end up getting numbered like that, but that is kind of a common convention. The relationship between project areas and TIF districts raises an extremely important TIF concept called pooling. When increment is spent outside of the district and in the project area, it's called pooling. And that's not a statutory term, it's just a term of common usage. The idea being that funds from multiple TIF districts can be pooled to fund project costs, although we still call it pooling even if there's only one TIF district. So just think of pooling as being out-district spending. There is an overall pooling limit of 25% for redevelopment districts and 20% for all other types of districts. But there's also an option for an authority to elect to pool an extra 10% for affordable housing purposes. 2 provisions that sought to focus TIF usage and promote early decertification are referred to as the 5-year rule and 6-year rule. The 5-year rule defines costs that are obligated after the first 5 years as being out-district costs that would have to fit within the pooling limit. And I'll get into the rationale a little later, but it's important to understand that the expenditures inside the TIF district are only in-district costs if they're spent or obligated within the first 5 years. And the 6-year rule requires generally districts to be decertified when there's sufficient information, when there's sufficient increment received to pay in-district costs and obligations, and that drives a lot of early decertification. And there are many big clarifications to the 5- and 6-year rule in 2023 that our office had proposed. So again, it's not just the location, but also the timing that makes something in district or out district. There are 5 statutory types of TIF districts in Minnesota, each with their own requirements and limitations. Redevelopment, housing, and economic development districts make up 97% of all the districts. There's also some renewal and renovation districts and soil condition districts. And some laws over the years have created different types of districts for limited situations. So for example, there's housing transition districts that were authorized for 4 cities, and there's a distressed rental properties district that was authorized for 1 city. Those narrow laws are uncodified. They're just in law, not in statute. Um, and There's also one type of subdistrict, a hazardous substance subdistrict that can be created within one of the normal district types that can capture an extra increment to address the remediation of hazardous substances that might be encountered. So as you can see here, redevelopment districts and housing districts can each collect increment for up to 26 years. Economic development districts are limited to 9 years of increment, given their more debated policy justifications. And renewal and renovation districts are limited to 16 years. Soils condition districts can collect increment for 21 years. Redevelopment and renewal and renovation districts are pretty similar in that each requires meeting a blight test where the authority has to find that certain conditions exist. So for redevelopment districts, parcels consisting of 70% of the area of the district must be occupied by buildings, streets, utilities, paved or gravel parking lots, or other similar structures, and more than 50% of the buildings, not including outbuildings, must be structurally substandard to a degree requiring substantial renovation or clearance. Alternatively, certain rail properties, tank facilities, or qualifying disaster areas can also get you qualified as a redevelopment district. For renewal and renovation districts, the same 70% coverage test must be met, but only 20% of the buildings need to be structurally substandard, and 30% of the other buildings must require substantial renovation or clearance to remove existing undesirable land use conditions like incompatible uses, overcrowding, or other types of hazards. So for both these district types, 90% of the increment must be used to finance costs that correct blight conditions that enable them to exist. Economic development districts must be found to be in the public interest because they discourage commerce, industry, or manufacturing from moving operations to another state or municipality, or they increase employment in the state or preserve or enhance the tax base of the state, or they satisfy requirements for a workforce housing project. These districts are limited, however, to certain uses. So no more than 15% of the square footage of the buildings and facilities can be for a use other than manufacturing, warehousing, storage and distribution, research and development, telemarketing as the exclusive use, tourism facilities, which do have specific qualifications, space necessary for or related to those uses, or for workforce housing projects, and which also have certain qualifications. So generally speaking, economic development districts are not meant for commercial and retail developments, as those types of activities should depend on the existence of a suitable local market, and they're not footloose like these qualifying uses are. But there is an exception for small cities, those that are less than 5,000 in population, that are located 5 or 10 plus miles as the crow flies from a city of 10,000 or more. So the requirement had long been that you had to be at least 10 miles plus from a city of 10,000, but that was just recently changed in 2023 to be a 5-mile plus parameter for new districts going forward. So these cities may assist commercial and retail facilities up to 15,000 square feet. But for these districts, increment may only be used to assist those facilities and to pay administrative costs. They cannot pool for any other purposes. Housing districts are for low and moderate income projects, as they're defined in federal, state, or municipal laws, and are aimed at increasing the supply of affordable housing. Tax increment from these districts may solely finance the cost of housing projects or pay related administrative and public improvement costs. And because such housing developments are generally considered in district, even if they're located outside the district, pooling limits generally are not applicable to a housing district. And a small portion of buildings can be for non-residential uses, like a street level shop in a multi-story housing complex, but that's limited to 20% of the square footage of buildings. So at least 80% has to be residential. There are income requirements that apply to qualifying projects. So for owner-occupied housing, the initial purchaser and occupant has to meet the requirements for a qualified mortgage bond project, as that's defined in the Internal Revenue Code. And generally what that means is those projects require the income to be less than or equal to 115% of the area or state median income. And for rental housing, properties must meet the requirements for a qualified residential rental project, again, under the Internal Revenue Code. And those projects can meet one of two tests, where either 20% of the units are occupied by those with incomes that are less than or equal to 50% of the area median income, or 40% are at 60% of the area median income. And then there's also an MHFA challenge program that has some separate income limits that can also be substituted. Soils condition districts may be used when an authority finds hazardous substances or pollutions or contaminants that require removal and remedial action, and where the estimated cost to correct is greater than $2 a square foot. And for these, a development action response plan has to be approved by the Minnesota Pollution Control Agency. And tax increment may only be used to pay for acquisition costs, removal and remediation costs, and administrative costs. Hazardous substance subdistricts are generally used within one of the other types of districts when pollution and its additional costs are encountered, as part of the development. And it's for parcels that are designated as hazardous substance sites and contiguous parcels. The authority must find that the development or redevelopment would not occur through private investment or other increment, and that any contiguous and non-designated parcels are expected to be developed along with the designated hazardous substance sites in order to use it, and that the subdistrict is not larger than and will not collect increment longer than is necessary to cover the additional costs. And those subdistricts also require the PCA to approve development action response plans. These subdistricts create additional increment by reducing the original base, generally to zero. And those additional increments, again, can only be used to pay removal and remediation costs, pollution testing, demolition and soil correction, insurance and liability protection, and administrative and legal costs. Including, by the way, legal costs incurred by the PCA or by the Attorney General, who might get involved to try to hold the polluters accountable. All right, well, before we get back to our the different components of our definition of TIF, I want to check in here and see if we have any early questions so far.
No, I haven't seen any questions so far. Early on, it seemed like a few people had some technical difficulties seeing the slides. So if that's happening for you, maybe just try to exit and re-enter the Teams webinar. But other than that, it looks like those got resolved, and
okay,
that's it.
Great. Okay, good. Well, let's then launch our first poll question here, and give you a chance to think about everything I've said a little bit so far. So the question here is, the income limits for housing districts apply only to the initial occupant for A, owner-occupied housing, B, rental housing, C, both, or D, neither. We'll give you like 10 seconds here or so to answer. We're not keeping score, just seeing if you picked up on what the answer is.
All right, I'm going to close this.
Okay. Well, looks like most people answered C, both, but the correct answer actually is A. So maybe the presenter here didn't deliver it very well. It's only for owner-occupied housing where the purchaser and the initial occupant has to meet the income limits. For a rental housing, the income limits are an ongoing thing that has to be monitored for the whole life of the district. So so when you have an owner-occupied house TIF district, you only really have to monitor the initial purchaser and occupant. But when you're doing rental housing, you have to monitor the compliance with the income limits for the life of the district. So it's good we had that question to make that clarification then. All right, well, let's continue then and get back to our definition here and look at its various parts. And so the first thing we noted was that TIF is a financing tool. So it's worth noting that TIF is not an incentive that's a tax break or a tax reduction or a tax abatement. The taxpayers in a TIF district do pay their full property taxes on the parcel, even on the new captured value. It's just that the taxes that they pay, those incremental taxes that on the captured value, they become a revenue stream. They become the tax increments that the TIF authority uses to finance the costs and that help enable the development. So it's a financing tool rather than just a tax break incentive. And because development costs are generally incurred up front while the tax increments are collected over the duration of the district, debt obligations are necessary and become an important consideration when using TIF. The most common type of TIF debt obligation, representing 71% of all TIF debt for 2023, is a pay-as-you-go or pay-go note, where the authority has an agreement to reimburse the developer, owner, or note holder for the qualifying costs that the developer or the owner incurred and separately financed. So these have been becoming increasingly popular over time, and you can see here just over the last 10 years, they become more and more popular. And that's because the risk for these TIF districts is not borne by the TIF authority should the actual tax increments end up falling short of projections and become insufficient to pay all the costs. So that transfers the risk to the developer or the note holder. General obligation bonds or GO bonds are still used quite commonly, but they were much more common in the early years of TIF. And with these, the municipality pledges its full faith and credit and has to raise its taxes to pay bonds if tax increments are not sufficient to pay them. So that used to be far more common. And then revenue bonds, which only pledge like tax increment revenues or maybe special assessment revenues, they're much less commonly used because I think they're less attractive to investors who bear more risk, and then they become higher interest rates and more financing costs. So they're less commonly used. And then many districts make use of interfund loans, where the internal dollars are borrowed from like a different fund of the municipality. Usually, though, that's to cover supplemental costs like administrative costs. The city will pay administrative costs early and pay itself back later with increments. It's not usually used as the sole funding source for a TIF district, although we've seen that a couple of times anyway. So now let's look at the second part of the definition, which is this notion of capturing new value. Let's look at an example here where a vacant, deteriorated, structurally substandard property before development has a market value of $200,000, and then the proposed development would be valued at $3.4 million after the redevelopment. So when a TIF district is created, the authority must request the county auditor certify the original value of the TIF district. Any new value in subsequent years, which is measured as the current minus the original value, will be identified as captured value. So with our example, here we see the market values on the left and the equivalent net tax capacities or NTCs on the right. NTCs being the values that are used for property tax calculations. And so as a quick aside here, the terminology of net tax capacities may be familiar to most, but maybe not all of you. So if you're new to Minnesota's property tax terminology, it might strike you as a confusing term, and you might wonder, why are those amounts so small relative to the market values? It's named this way because the 1988 legislature decided to define values to be similar in proportion to the desired effective tax amounts. And thus the name comes from the desired net tax capacity. And the thinking is that high and low tax rate areas could be judged by how close the tax rate was to 100%. And well, things never really worked out like they envisioned it would, but we're stuck with this weird terminology for what most states just kind of call us, assessed or taxable value. And now we have values that are expressed as really small amounts and rates that are expressed in large percentages. But anyway, getting back on point here, for this example, the TIF district is comprised of a parcel that had a base year market value of $200,000 or $3,250 in net tax capacity. And then after development, it had a 3.4 million market value or $67,250 in net tax capacity. So 3.2 million of the value is captured, or more specifically, $64,000 of there's $64,000 of captured net tax capacity. So captured value is not part of the tax base, meaning it's not used to calculate the tax rate, and it's not used to generate local tax levies. The tax rate, though, is still applied to captured value, and that's what yields the tax increments that finance the development costs. So before continuing, I got one more quick aside for you, and especially for those that might be more interested in TIF as a feature of the property tax system. When we talk about capturing tax base, it should be noted that there's different property tax bases. And to describe this very briefly, property taxes are generally the result of a value times a rate. And that value starts with the assessor's determination of estimated market value. However, there's all kinds of exemptions and exclusions and value deferrals that are baked into the Minnesota property tax system. So it's not all taxed at its full market value. And so then we have a term called taxable market value. And that becomes the starting point for two different tax bases. Net tax capacity is the main tax base for most property tax levies. And it's determined by multiplying that taxable market value times a class rate based on the property type, like commercial versus homestead. And those are small percentages, and that's how we get values that are more comparable to tax amounts in terms of order of magnitude. So like for residential, the class rates are generally around 1%. For commercial, they're generally around 2%. For some property taxes, though, use a different tax base called referendum market value. And referendum market value is typically equals the taxable market value or some portion of it for select classes of property. So for example, farmland is not subject to referendum market value levies. So there's one more wrinkle here, though. The net tax capacity is split into two different tax bases because the state property tax is levied on net tax capacity, but only for certain property types like commercial and seasonal property. So county tax systems distinguish between the local NTC and the state NTC as different tax bases. So the point of all this, though, is that know that TIF only captures value for local net tax capacity-based tax levies, which is most levies. TIF, though, does not impact the state net tax capacity or otherwise affect the state property tax levy, and it does not capture or otherwise affect referendum market value-based levies. All right, this brings us back to the next part of our definition, where we say that property taxes on captured value are segregated as tax increments. So we've said that the tax rate is applied to the captured value, creating additional taxes above the local levy amounts. And to illustrate this using our example, the tax base value that will help support local net tax capacity levies will basically remain that value of $3,250 for the duration of the TIF district. So from the perspective of the taxing entities, look at their tax base, it's as if that new development hasn't even happened. And when you apply the city, school, and special taxing district tax rates to that original value, you might say get $4,448 of taxes that support local levies. The tax rate, though, still gets applied to that captured value. And so when that's done, you end up with $87,594 of tax increments. And so that's revenue that's separately identified, and it's not part of any of the levies, and it's distributed by the county auditor to the TIF authorities, and those TIF funds are used to pay development costs. So the implications, though, on the tax base rates and levies should be well understood. Capturing value from the tax base directly affects rate calculations. Tax rates are determined by dividing a jurisdiction's adopted property tax levy by the value of its tax base, which excludes that TIF captured value. So for example, let's assume the city has a total tax capacity of 1,064,000, and the TIF district captured the 64,000. That leaves a tax base of $1 million to support local levies. And say the city levied 467,700 of property taxes. So the city tax rate would be 46.770% when calculated using the tax base that excludes captured value. If the TIF district were terminated, though, or if TIF weren't needed, and the 64,000 of captured value became available to support that same levy, the tax rate would only need to be 43.957%. So understand that tax increments are additional taxes beyond the levy amount. They're applied to the uncaptured tax base. So when you apply the tax rate to the uncaptured tax base, you get the full levy amount. And then when you're applying it to the captured value, you get additional taxes. And in the case of the city here, you'd get an extra $29,933 of city taxes. So this is just the city share of that $87,000 amount that we saw in the previous screen. So the county and the school and the special district taxpayers are also paying a portion of all of that. So the captured tax base may also be indirectly impacting judgments about how much each entity wants to levy, given the sensitivity to higher tax rates. So in this example, if the TIF district were terminated or decertified, the city could raise its levy to maintain the same tax rate, or it could keep the levy the same and let taxpayers enjoy eased tax burdens, or it could do something in between. And so you can see here how new tax base is super positive when it wouldn't have existed without TIF, and how using TIF to create that can be a very positive thing after the TIF district ends. But if you're capturing tax base that would have existed anyway without the use of TIF, then it has the opposite implication of raising rates and taxes and putting more pressure on levy decisions. So, and I've got a model here that can kind of illustrate the concept a little more. So let's say the general premise of TIF from its redevelopment origins was that a property might be blighted where its value is declining or stagnating, and this is expected to continue absent any public intervention or assistance. And when the TIF district is created, the original value at that point in time is established or frozen as the tax base for the duration of the district. But with the public financing of TIF in place, the development is enabled, and that new value, the value increases as a result. And again, the tax rates still apply to that new value, so you get the tax increments that are not part of the tax levy. And then when the TIF district ends, that's when taxpayers realize the public benefits of the endeavor, as that new tax base is available to support local levies. And the captured value that provided the tax increments is generally viewed neutrally as the investment that made the benefits possible, rather than negatively as economic loss, given that the development wouldn't have happened but for the use of TIF. And this but-for test is crucial to the proper use of TIF. The statute requires that the municipality be able to make a finding that, in its opinion, the proposed development would not reasonably be expected to occur solely through private investment within the reasonably foreseeable future, and that the increased market value of the site that could reasonably be expected without the use of TIF would be less than the market value of the proposed development after subtracting the present value of projected increments. So in other words, the additional value created by the use of TIF must exceed the value of the investment of increment. And why is the but-for finding so important? Well, in our conceptual model, we started with the premise that the value was declining or stagnating, and that this was going to continue for the foreseeable future absent any assistance. But if instead the proposed development would occur without the use of TIF, then the conceptual justification disappears. And when the TIF district is created, that freezing of the tax base for the duration of the TIF district and the capturing of value to generate increment Well, it represents an economic loss where the tax base that could have supported local levies is instead providing a subsidy to the development. And so this illustration highlights kind of the worst case scenario where the proposed development definitely would have happened without TIF. But of course, it may not be so easy to assess what would or would not happen without TIF. The but-for finding, after all, involves some subjectivity. And it's unlikely to be such a black and white thing that either no development would ever occur without TIF or that the proposed development would surely occur without TIF. Judgments have to be made about what would reasonably be expected to occur over a time horizon that could be 26 years. So perhaps only some modest undesirable development might be expected later in the time horizon, or maybe something nearly comparable would follow quite soon. But in between, there's all kinds of possibilities. So like, let's look at this example of maybe absent the use of TIF, some different development would have occurred later on in the TIF district's timeframe. And in a situation like this, the start of the district does lead to a higher value development, and the capture of value and increment is neutral until you get to that point where the value would have existed without TIF begins to kind of be an offsetting economic loss because that would have been available without the use of TIF. And in the end, there is public benefit. It's just that it's offset to some degree by that intervening economic loss. And so a model like this doesn't account for the immediate benefits of like job creation and economic activity, but it kind of illustrates how taxpayers may experience things with the use of TIF and how important it is for a municipality to make a studious assessment of the but-for finding. And note that these impacts are not just felt by the city or the TIF authority alone. And while a TIF authority might hold all the decision-making power about using TIF, the decision impacts all of the local taxing jurisdictions, and the county, cities, school districts, and special districts all see their tax base locked into that original value and do not benefit from the new value for the duration of the TIF district. One step that's an important part of approving a TIF district is to give copies of the proposed plan to the county and the school district. But other than an infrequently used option where counties under certain circumstances can require some road costs to be paid with TIF, a TIF authority is not bound by any of the input that they get back. So, but it's still good to give that input its due consideration as a dutiful part of approving TIF districts. All right, well, let's stop again here and see, do we have any questions, or are we ready for another poll question?
Nope, I haven't seen any questions yet, but don't be shy, everybody. But I will launch this poll question.
All right, so this question is, which of the following statements is true? A, TIF always increases tax rates. B, TIF never affects tax rates. C, TIF's impact on tax rates depends on the but-for test and timely decertification. I'll give you a few seconds to give that one your best guess.
Okay, I'm gonna close it.
All right, it looks like C got the most, the overwhelming answers, and that is correct. If the but-for test is true and the tax base wouldn't exist, then TIF isn't really causing a tax rate increase. But it's kind of presumptuous to assume that that test is always perfect. And while I haven't gotten into this yet, we'll see that if a district runs too long, you kind of get to a point where the capture is no longer completely necessary. So yeah, really, whether, how much of a tax increase you're experiencing kind of depends on whether you've got a good but-for test and you're decertifying in a timely manner. All right, well, let's get back then to our definition. There's one more detail to cover here regarding the identification of increments. Property taxes are not just a value times a rate. There's also credits that can reduce the gross tax that is due to the net tax that the taxpayer actually has to pay. And gross tax includes both tax increment and regular taxes. So any of these TIF or property tax credits, they proportionately reduce both levied taxes and tax increments. And often there's credit reimbursements that are paid by the state. So you might see that a TIF share is identified for those credits. And most credits, though, don't apply to the types of property that are normally found in TIF districts. There's not a lot of commercial industrial property tax credits. So, but generally the Department of Revenue, they reimburse the amount of TIF that's reduced by credits. And for 2024, they only listed 7 districts in 5 counties. And other than the disparity reduction credits, the amounts were really quite small. So this doesn't impact a lot of people, but just be aware that you might see if there's a TIF share of a credit that you see identified that you're getting a distribution of increment or of credit reimbursements. Understand that those credit reimbursements are tax increments and they need to be segregated as part of the tax increments that are generated by the TIF district. All right, next part of our definition here, tax increments are used to pay qualifying costs that enable development to occur. So qualifying costs might include things like the costs for land acquisition, demolition, utilities, streets, and sidewalks. TIF is meant to be an enabling tool that addresses market failures or costs that serve as obstacles to free market activity. So, and that's kind of easy to see in the case of redeveloping blight. With a housing district, most housing developers tend to focus on market rate development, and unless they're incentivized in some way to include affordable units. And so TIF has some justification there to generate more affordable units. And then the case for economic development is subject to more debate, but it's in reality, there's some sectors like manufacturing and warehousing and other industries that are competitive and footloose and locate anywhere. And so, you know, some subsidy becomes an important factor in getting them to locate in Minnesota or in Minnesota City. So, and as we've seen looking at the conceptual models and the but-for test, TIF is not meant for developments that are likely to occur without the need for its assistance, and likewise not for costs that are unrelated to enabling that development to occur. And so one consideration for a TIF authority is to think about right-sizing the use of TIF or using it to its proper extent. In our prior example, we saw that capturing $64,000 of net tax capacity raised $87,594 of tax increments in 1 year. So for a redevelopment district, which can collect increment for up to 26 years, that district might generate close to $2.3 million over the life of the district. But what if only $1 million of assistance is needed to make that development possible? This raises the important consideration of examining the extent of costs and activities to include in a TIF plan. And without getting into all the required elements of a TIF plan, there are certain estimates that must be included. A TIF plan must include estimates of bonded indebtedness, original net tax capacity, captured net tax capacity, and the duration. But more importantly, the plan must contain separate estimates that set the total authorized cost for a TIF district. So it must separately identify the cost of the project for things like acquisition and site improvement costs and including administrative costs. Then must identify interest as a financing cost and identify the tax increment to be generated over the life of the district. So these 3 estimates kind of establish the total authorized costs or budget, if you will, for a TIF district. And the total of project costs and financing costs that would be paid with tax increment cannot exceed the total estimate of revenues. So setting appropriate TIF plan estimates is an important consideration. Some might advise maximizing the estimated costs to enable the maximum expenditure of increments as a revenue source? Or is it better to minimize those expenditures to what is necessary and terminate the district as early as possible and start reaping the tax-based benefits? Another initial consideration is deciding whether to set an earlier duration limit than what is allowed by statute. 26 years, for example, might be far too long to tie up the tax base if the necessary cost could be financed in only 10, 12, or 15 years. And then there's an opportunity to share captured value or just to continue to monitor things and decertify early. And to explain this last bit, let's say an authority, or be aware that an authority has a seldom used option to share instead of fully capture the new tax base. So in this scenario, if from our earlier example, $20,000 of that $64,000 were shared with the tax base instead of being captured, then that frozen base is essentially raised to include some of the new value. And that would represent an immediate public benefit that could be enjoyed for the duration of the district. But the risk here is whether the diminished tax increments on the remaining retained captured value would be sufficient should the growth in value end up being less than projected due to maybe the actual size of the development or market conditions or legislative changes that might impact property taxes. And so that's why most authorities choose not to share value, and a more attractive option may be to decertify the district once the increment has been sufficient to pay for the necessary costs. So this is consistent with the 5-year and 6-year rules direction to identify the core in-district costs in the first 5 years, and then to decertify once sufficient increment is available to pay those costs. The idea is to limit increment capture to what is needed to achieve, and then achieve early decertification and enjoy the benefits of an expanded tax base as early as possible. And early decertification is actually very common. Based on decertifications that occurred from 2019 to 2023, 76% of redevelopment and 75% of housing districts decertified early, and not just early by a year or two, but on average by 10 years. And even economic development districts that have shorter durations to begin with decertified early 40% of the time. So early decertification has grown to be the norm and is increasingly common. Sometimes we encounter municipalities that delay decertification and they hold on to surplus increment revenues, or they're wanting and are kind of wanting to keep the stream going for more expenditures, particularly pooling for out-district costs and more administrative expenses. However, as we've seen, decertifying early does maximize tax-based benefits. And when unused increments are returned to the county auditor, they're actually distributed back to the county, the city, and the school district in proportion to their tax rates. And those redistributions become free of any TIF restrictions and can be used for any municipal priorities. And so sometimes we see this false notion being expressed that you don't want to give the increment back to the state, but that's not the case. It goes back to the local governments, and so you actually get your share of that back if you return it. And it's wise to think broadly and consider the impact on all the taxing jurisdictions and not just the municipality. All right, so at this point, we've largely covered the kind of an overview of the core concepts, but I do want to speak a little bit more about the history and give some final thoughts. And before we finish up with that, do we have any questions, or are we ready for another poll question?
Nope, I haven't seen any questions.
Okay, well, let's go with another poll here then. So this is a true or false question. The statement is, TIF districts usually last their full duration or end just a year or two early. Is that true or false?
Great, I'm gonna close that.
Right. I think we've got a few cynical people thinking this is a trick question, but the majority here is correct. The answer is false. Most districts are actually decertifying early now. And when they do, the average is more than just a couple of years early. So yeah, there's definitely TIF districts that run their full duration, and not just a few, but most districts nowadays are decertifying much earlier. So. Okay, so a brief history will provide some good context for you. TIF originated nationally after World War II to address urban blight, and it was meant to make redevelopment competitive with sprawling development. And the use of TIF for housing and economic development were ideas that expanded later on. The TIF concept was first included in Minnesota statute actually back in 1947, but it was essentially ignored and inoperable until it was incorporated into the various development acts that we were looking at earlier. And those kind of came into, they were adopted between like 1969 and 1974. And so the early usage, though, struggled a little bit because those acts and there were issues that arose about how to actually operationalize TIF. And so the TIF Act was enacted in 1979 to kind of bring about the order and clarity and some basic limitations. And then looking here at the timeline of TIF in Minnesota, as TIF began in Minnesota, there was substantial early growth. The number of cities that were using TIF went from 4 in 1974 to 57 by 1979. An increment went from $400,000 to $7.4 million. But counties and state legislators were beginning to express concerns about some of the impacts that those districts were having, and because there were many operational issues. And so again, the 1979 TIF Act brought about uniformity and clarity about how TIF was actually supposed to work. And it also introduced some basic limitations to address those early concerns. This clarity of process, however, actually resulted in massive growth, and the concerns of counties and legislators actually grew with it. So from 1988 to 1990, there were major new implementation limitations imposed on TIF. And although the growth continued, it did so at a more moderate pace. And TIF continued to receive scrutiny from the legislature. In 2001, the 2001 tax reforms had two major impacts. Class rate reductions on commercial industrial property were cut, and that caused a loss of about 30% of tax increments statewide. And there was also the state takeover of general education levies that largely eliminated the concerns that legislators had about school aid interactions. And so then with TIF no longer being seen as driving up school aids, legislative scrutiny kind of waned a little bit, even as moderate growth continued. And changes to the TIF Act have been much less frequent and significant since then. By 2008, the amount of tax increment being generated had peaked and began to decline as we started to see a wave of decertifications, as a lot of those original old, very large TIF districts began to hit their maximum durations and started decertifying. Well, we saw a big drop off in the total amount of increment being collected statewide. Then in recent years, it looked like maybe it was leveling off into an equilibrium, but then we saw a couple of years of resumed growth before a couple of years of decline, and now another year of increase this past year. So it's a little bit, we're waiting to see where we go from here. All right, in this course, we're not going over all the restrictions on TIF. There'll be much more of that on Thursday. So you don't need to absorb all of the material that I've thrown on this screen. I've just put it on here to sort of illustrate the scope of provisions. You can see in the original TIF Act, there were quite a few just kind of basic provisions, and then there was a whole bunch of changes in the 1988 to 1990 reforms. Arguably, the biggest problem in the early years of the TIF Act was using pooling along with plan modifications to expand the scope of TIF districts to spend all of the increment generated over the full duration of the district, going well beyond the original proposed developments. And to address that, pooling was limited to 20 to 25% of the total, and we got the 5 and 6 year rules that were introduced that required, kind of defining more what the industry costs were and promoting early decertification when those could be paid off. And then you can see changes since then have been kind of much less significant in scope and kind of intermittent when they've popped up. In 2023, we saw a set of significant changes that was probably the biggest changes since those 1990 reforms. The OSA got together with various stakeholders to discuss a bunch of clarifications and improvements to the TIF Act. There was a fair amount of ambiguity that hindered people's understanding of and compliance with, and kind of hindered our oversight of various laws. And so the biggest changes we made were to the 6-year rule and other pooling provisions, but we also made clarifications of administrative expense provisions and some of the statutes that dealt with our oversight and how to handle violations. There were some clarifications there too. There were no changes in 2024, and this year there was just one general law change that affected the temporary transfer provision that was enacted during the pandemic. So given the scope of restrictions and limitations and other legal provisions, getting legal and professional advice is a good idea when you're using TIF. There are legal considerations not just in establishing a TIF district, but also in its ongoing operation. Provisions may require actions like returning increment or decertifying early or providing notifications, addressing errors, properly reporting, and remedying violations. And beyond the legal compliance issues generally, there's still significant administrative commitment to using TIF, and it's one that can last 26 years or more. So TIF requires long-term commitment to segregate and track funds, to monitor legal compliance, to maintain and retain documentation, and to complete reporting obligations. And therefore, municipalities should honestly assess their own administrative capacities and to take care to establish some clear duties and processes so you can avoid the consequences that might follow from poor record keeping or improper activities along the way. So finally, please note that one of your handouts, which Haley emailed out and is I think linked in the chat, gives you some helpful resources on our website where you can, if you haven't signed up for our weekly updates, those are emailed every Friday and posted on our website. That's where we kind of post little news and notes and reminders. So that's valuable to follow if you're not doing that already. We also have lots of statements of positions, training videos, and articles. And for county folks, you can find a county guide to TIF on our website as well. And we also have a link here to the Department of Revenue. They've got a good auditor treasurer's manual that has some good resources. And they also offer some instructions for fiscal disparity calculations. So with that, are there, before we end here, are there any questions?
I didn't see any.
All right, very quiet group today. I hope you enjoyed this and got something out of it, and I hope you all have a good rest of the day. Here's the contact information for our office. If you've got a question you want to email us, and we'll just kind of leave this live for a couple more minutes, but I hope everybody has a good rest of the day. Thank you for joining us.
Thanks, everybody.